Unlocking financial success. The power of understanding financial statements. Understanding financial statements is like having a superpower in the world of money. It's your key to unlocking financial success. Don't let complicated numbers and jargon intimidate you. We'll break it down together step by step. Think of financial statements as a company's report card. They show you how well a company is performing. They reveal its strengths and weaknesses. By learning to read these statements, you gain valuable insights. You can make smarter investment decisions. You can evaluate the financial health of businesses. You can even manage your own personal finances better. It's all about empowerment. Let's embark on this journey of financial literacy together. I promise you it's easier than you think. Demystifying financial jargon key components. Explained. Let's demystify some common financial terms you'll encounter. PE ratio. This stands for price to earnings ratio. It tells you how much investors are willing to pay for every dollar of a company's earnings. A high PE ratio might mean investors are optimistic about future growth. Liquidity. This refers to how easily a company can convert its assets into cash. Think of it as a measure of financial flexibility. A company with high liquidity can pay its bills on time and handle unexpected expenses. Profit and loss. This statement shows you how much money a company made, revenue, and how much it spent, expenses, over a period of time. The difference is the company's profit or loss. Debt. This represents money a company owes to others. It's important to look at a company's debt levels to see if it's manageable. Hard assets. These are tangible things a company owns, like buildings, equipment, and inventory. Soft assets. These are intangible assets, such as brand recognition, patents, and trademarks. Future projections. These are estimates of a company's future performance. They're based on factors like industry trends and economic conditions. Understanding these components gives you a solid foundation for analyzing financial statements. Real-world examples, bringing financial statements to life. Let's say you're considering investing in a coffee shop. Here's how understanding financial statements can help. PE ratio. You compare the coffee shop's PE ratio to other coffee shops in the area. This helps you see if it's overvalued or undervalued. Liquidity. You check if the coffee shop has enough cash on hand to cover its expenses. This tells you if it's financially stable. Profit and loss. You look at the coffee shop's profit margin to see if it's making money. This helps you assess its profitability. Debt. You find out how much debt the coffee shop has. This tells you if it's taking on too much risk. Hard assets. You consider the value of the coffee shop's equipment and location. These assets contribute to its overall worth. Soft assets. You think about the coffee shop's brand reputation and customer loyalty. These intangible assets are valuable too. Future projections. You research industry trends and economic forecasts to get an idea of the coffee shop's potential for growth. By analyzing these factors, you can make a more informed investment decision. Section 4, PE ratio in action, assessing a company's worth. Imagine two tech companies, Company A and Company B. Both are in the same industry and have similar earnings. However, Company A has a price-to-earnings ratio of 30, while Company B has a price-to-earnings ratio of 15. This means investors are willing to pay twice as much for each dollar of Company A's earnings compared to Company B. Why? It could be because investors believe Company A has stronger growth potential. Maybe they have a cutting-edge product or a larger market share. Or it could be that Company A is simply overvalued. The PE ratio alone doesn't tell the whole story. It's crucial to consider other factors like the company's financial health, industry trends, and management team before making any investment decisions. Remember, knowledge is power. Section 5. Debt and liquidity, gauging financial health. Let's talk about debt and liquidity. Imagine a company with a mountain of debt. They're constantly struggling to make interest payments. This puts them in a risky position. On the other hand, a company with low debt and high liquidity is like a sturdy ship sailing through calm waters. They have the financial flexibility to weather any storm. When analyzing a company's financial statements, pay close attention to their debt-to-equity ratio. This ratio compares a company's total debt to its shareholder equity. A high debt-to-equity ratio indicates higher financial risk. It's like having too much weight on your shoulders. You want to see a company with a manageable debt load and enough liquidity to meet its short-term obligations. Section 6. Making informed decisions, your path to financial empowerment. Congratulations! You've taken a crash course in understanding financial statements. Remember, this is just the beginning of your financial journey. The more you practice reading and analyzing these statements, the more confident you'll become in your financial decisions. Don't be afraid to ask questions, seek guidance from financial advisors, and continue learning. Knowledge is your most valuable asset. By empowering yourself with financial literacy, you can take control of your financial future and achieve your dreams. Remember, I'm here to guide you every step of the way. Now go out there and make smart financial choices.